Over the past 30 years, we've worked with thousands of individual investors. Over that time period, we found that most investors have some combination of three specific goals. In this video, we'll share the three-part framework we use when constructing client portfolios, identifying what goals and what portfolio is most appropriate for each person. In next week's video, we'll talk about our different investment models and which of these goals each investment model is designed to fit. If you want to know when that video comes out, be sure to hit the subscribe button down below and hit the bell icon so you get a notification when we post that video. First, let's talk about why goals matter. The first thing we do with every client before investing a single dollar is to understand what their goals are. This is extremely important anytime you're building a portfolio, either for someone else or for yourself. You have to know what are you trying to achieve and then design a portfolio that meets those objectives. If you get part of that equation wrong, it's very easy to build a portfolio that does something entirely different than what you're actually needing it to do. So what are the three primary goals that most investors have? A helpful way to understand this concept is to think about art class. So I remember when I was in second grade, Miss Englehart showing us that the three primary colors essentially make up all other colors. So in the same way, the different goals are not necessarily binary each one. Sometimes an investor will have a preference for only one, but in most cases, we're talking about a combination of these different primary colors or primary goals, which are security, income, and growth. Let's briefly define each one. Let's start with security. We would define security as minimizing risk, and we would define risk as not achieving your financial objectives. And the need for security can really come down to two things. One is financial need. A financial need for security would be a case where you have money that you need at some point in the future. So it's important that we minimize the probability that you will not have that money when you need it. To illustrate, let's say that you need $25,000 to pay for your daughter's wedding. You need this money in 12 months. And so you hear that stocks are the best long-term way to grow your money. So you're very focused on growth. The problem is that over a 12-month time period, stocks can go down, sometimes by a lot. In this case, you've taken on too much financial risk. There's a chance that this $25,000 may be worth less whenever you need to take the money out. To mitigate the financial risk here, it'd be most appropriate to put the money in some sort of instrument that you had a very high chance that 12 months from now, you'd still have at least $25,000 plus some amount of interest. Another part of risk is behavioral, and this is probably the biggest one that almost all investors face. Even if you have the financial risk minimized as much as possible, there's still a behavioral component. Someone who's age 30, let's say, and starting to invest in their 401k, they face risk not as much financially. They have a long time period till retirement, and they're actively adding money to their portfolio, but they still face risk if the market were to fall and they would sell at the lows. That could hurt their long-term financial future, and again, put them at risk of not achieving their objectives. So before you put together a portfolio, you need to know your own financial situation. When do you need money? How much do you need? Map that out over the next couple of years, ideally even longer than that. Have some kind of a financial plan put in place. The second part is understanding yourself. Do you have a tendency to sell and panic if the market declines? If so, you have an elevated amount of behavioral risk that you either need to adapt into your portfolio or add some sort of external behavioral coaching. This could be through a financial advisor, maybe a trusted friend, a written document, something like that, to help mitigate your behavioral risks. The next objective we see is growth. Now, growth can really come from two places. First is the one most people think about, and that is total return, meaning the price increase and the dividends or interest of a particular portfolio. So this is growing the long-term value of your account. But another part of the growth equation is dividends. But a lot of our clients spend the dividend income generated by their portfolios to cover their expenses. And as expenses grow, it's also important that the income or the dividends from the portfolio also grow to keep pace. And finally, the third need that we see is income. You need to take into account how much of your portfolio do you need to spend, where should that income come from, and what kind of investments do you need in order to support that income. Those are the three primary goals we think all investors have, at least in some combination. But just like with the three primary colors, there's a million different ways that you can combine colors, combine goals to come up with your specific individual goal. It's rare do we find someone that's 100% growth or 100% security or 100% income. A lot of times people are somewhere in between. For example, I would say I am probably somewhere around here. I'm actively accumulating long-term wealth. However, I don't like the volatility that some of the more aggressive investment strategies offer, and we'll talk more about that in a little bit. But I would say I'm probably about 60% growth as a goal, and then about 40% security. And so when I'm designing a portfolio for myself, I want to be specific about how much risk I can handle. And again, remember, we're talking about behavioral and financial risks. For me, it's more of a behavioral risk. So I might want to design a portfolio for myself that in any given year would go down no more than, let's say, 30%. If that's my specific security goal, I can build a group of stocks or ETFs to fit that particular constraint. If you're someone who's currently in retirement, you may be on the complete opposite spectrum, where your priorities at this point are more security and income and less focused on growth. Each person is unique. You have your own financial situation, you have your own specific needs from your portfolio, you have your own behavioral risks, financial risks. So before you build a portfolio, you need to know where exactly you fit in these three objectives. The more specific you can be, the better. It's also important to remember that there's a trade-off between each of these objectives. Just like with the colors, you're always moving from yellow to blue, from blue to red. When you add a new color, you're also moving away from other colors. In the same way, you can't simultaneously have the potential for 10%, 15% plus annual growth rates and also have minimal downside risk and also have a 7% dividend yield. As you reduce the risk of a portfolio, you naturally also reduce the income and growth potential. Adding income generally results in lower growth and vice versa. So identifying what you need from each of these three will help you figure out what are these specific deal-breaking constraints that you absolutely can't live without, and find the best balance of your portfolio that, again, fits what you're looking to get out of it. To illustrate this, let's look at a few different examples, each one of these at the different extremes. So we'll look at one investment that may be appropriate for a 100% growth investor, one that would be 100% secure, and one that would be 100% income focused. So we'll start here with growth. Let's say you want a 100% growth portfolio. Well, you might look at something like the NASDAQ 100. And if you look back at data from 1999 through July 2026, the time of this video, the NASDAQ generated a compound annual growth, meaning dividends and prices, of 11.1% annually. However, as we saw with the security, income, and growth trade-off, if you're right here maximizing growth, that also means that you're moving pretty far away from securities. So if you look from March of 2000 through October of 2002, the NASDAQ 100 had an 82.9% drawdown top to bottom. Most people cannot stomach this level of volatility without eventually giving up and moving to something more conservative, which is not something that you want to do. So there's another one here, example of the financial crisis when the NASDAQ was down 53.4%. And you also have several instances in the last 8 years or so when the NASDAQ has dropped by at least 20%. The biggest of which, whenever the Fed raised interest rates, top to bottom, the NASDAQ fell by 35%. So the potential for long-term growth comes at the expense of security and also income. The NASDAQ pays a very low dividend yield. On the other extreme, moving to security, the safest investment in terms of not losing money might be putting money in your mattress. Obviously, you have inflation risk in that scenario, but let's say you wanted to identify the best security for minimizing financial and behavioral risk over the course of the next 3 months. Well, you can invest in 3-month treasury bills. The current annualized rate is 3.9%. So this would keep your money extremely safe. The problem is what you take in security, you're giving up in growth. You're not going to earn any more than a 3.9% annualized return, and there are cases when this income could actually go down. So once this 3-month treasury bill gets paid back to you, you're going to have to reinvest that money. And if the Fed lowers interest rates, like they did during the Great Financial Crisis, to near 0%, there's a chance that this return could drop significantly. And lastly, let's say that you wanted to maximize the income generated by your portfolio. At Donaldson, we only invest in investment-grade bonds and preferred stocks. However, for someone who is looking to maximize income as much as possible without using options or other exotic income generation assets, non-investment grade or junk bonds currently have an effective yield of right at 7%. But while those would maximize the income generation potential of the portfolio, again, you're going to give up growth. You're also giving up security. As I mentioned, we invest in investment grade bonds. And once you go into the junk bond, there's a much higher probability that if you have a recession or some kind of economic pullback, these bonds may not pay out the full amount of interest. And in some cases, they may default entirely and not pay you back, either fully or in part. Junk bonds also tend to experience stock-like volatility. So in a severe recession, you could also see the overall market value of junk bonds decline. So those are examples of specific asset types and how the trade-off of security, income, and growth might look like in practice. So if you're looking to assemble a portfolio that is something in between some of those extremes, it would be important to combine the different characteristics of different asset types, different stocks, different fixed income sources to match whatever goals you're trying to achieve. Speaking of goals and working with lots of clients over the years, it's important to remember that goals change. I used myself as an example earlier, since I'm probably about 60% growth, 40% security. However, as I get closer to retirement, I'm going to start shifting my needs a little bit more towards income. At some point, I'm going to need to generate income to cover my retirement spending. So my portfolio is naturally going to move a little bit more towards income. This is where we've specifically designed our rising dividend cornerstone strategy to fit. If you're interested in more, we'll talk about that in next week's video. But even after you've been in retirement for a while, we see a lot of times where people's goals start to shift. In some cases, maybe the portfolio has done very well and continues to grow year after year, and the need for income is no longer as great as it was. So the focus sometimes starts to shift more towards growth and away from security, even late into retirement. In other cases, life events can cause someone to move a little bit more towards income, trying to stretch every dollar possible out of the portfolio. And still in other cases, we've seen people shift more towards security as they start to try to preserve what they have as opposed to trying to grow it or generate income off of it. So not only is your specific situation unique right now, but your situation and your goals are going to change over time. So if that's you, if you're a client of Donaldson already, and you feel like your needs have changed over the last couple of years, be sure to talk to your advisor. Even if you don't work with Donaldson, talk to your advisor if you think your goals have shifted a little bit. It's important to always keep your advisor in mind and letting them know when things change, and if so, talk about how your portfolio should change to meet those needs. We'd also love to get any comments you have. You can leave a comment in the comment section down below, or if you're interested in contacting us directly, we'll put a link in the description down below. Thanks for watching, and we'll see you in the next video.